day, learners. In accounting, every transaction is guided by different concepts and principles that we need to follow. So stay with us in this video, and let's learn together the accounting concepts and principles that you need to learn and understand. Generally accepted accounting principles, or the GAAP, refer to a common set of accounting principles, standards, and procedures issued by the Financial Accounting Standards Board, or the FASB. Well, in the Philippines, the GAAP, or the Generally Accepted Accounting Principles, are the PFRS and the PAR, PFRS, or the Philippine Financial Reporting Standards, and PAR, the Philippine Accounting Standards. These are adapted from the IFRS, which is the International Financial Reporting Standards, and IAS, which is the International Accounting Standards.
The first concept is the economic entity or accounting entity principle. The personal transactions of the owner are separate from that of the business he or she owns. There is a borderline between owner transactions and business transactions. For example, when the owner spends money for a birthday party, that is a personal expense, not a business transaction. Next is the accrual basis of accounting. In accounting, we record revenue when it is earned and expenses when they happen, regardless of whether cash is received or paid. For example, if the revenue event happened in January but received by the customer in February, record it in January. Even expenses like electric bills paid next month are recorded when incurred. We also have other important accounting concepts. First, the going concern concept assumes that the company will continue operating indefinitely into the foreseeable future, and that closure is not imminent. Because of this, transactions are recorded as if the business will not close. Next, the monetary unit concept states that business transactions are expressed in pesos, providing a common and consistent unit of measurement. Lastly, the time period concept explains that business transactions are summarized and reported at regular intervals, such as annually, based on a calendar year or fiscal year.
First, the cost principle states that amounts in financial reports are recorded at historical cost, or the amount paid at the time of purchase, with no inflation adjustment except in cases of hyperinflation. Next, the full disclosure principle requires that all relevant information needed for informed decision-making be included in the reports. Then, the matching principle states that expenses should be recognized in the same period as the revenues they help generate to determine net income accurately. Lastly, the revenue recognition principle explains that revenue is recognized when goods or services are rendered, regardless of when cash is received. In addition, there are other important accounting concepts. Materiality refers to information whose omission or misstatement could affect users' decisions. Conservatism means choosing the more cautious option when two acceptable alternatives exist. Finally, objectivity ensures that accounting information is recorded and reported without bias.
Now let us move on to the qualitative characteristics of useful financial information. These are divided into two: fundamental and enhancing characteristics. First, the fundamental qualitative characteristics are the main qualities that make accounting information useful for decision-making. These are relevance and faithful representation. Relevance means the information can influence decisions by helping users predict future outcomes, predictive value, or confirm past expectations, confirmatory value. Faithful representation means the information accurately reflects what actually happened. It must be complete, neutral, and free from error so users can rely on it. Next, we have the enhancing qualitative characteristics, which improve the usefulness of information but do not replace the fundamental characteristics. Comparability allows users to compare financial information across different companies or time periods. Understandability means the information is presented clearly and is easy to understand. Verifiability ensures that different users can reach the same conclusions using the same information. Timeliness means information is available at the right time to influence decisions.
And that wraps up our discussion on accounting concepts and principles. We hope this helped you better understand how financial information is prepared and why accuracy and reliability matter in accounting. Thank you for watching, and we'll see you in the next discussion.